Hello, everyone. Thanks for joining me on another article. I'm happy to say that I have um, John and Jane's taxable and their retirement account formats set up. So I think this has gotten me to the point where I'll be able to actually get caught up because obviously we are in the month of October now, and I still have to do August and then have September's to do. So I'm thinking that it's going to be possible by about the middle of the month that I'll be able to have all of September, all of August and September's done. So let's dig in. On here, disclosure, I'm not a financial advisor. I don't claim to be one. This article reflects my own personal views, and I'm not giving any specific or general advice. This does not reflect any opinion on my employer. I do this purely for fun and also because I just really enjoy helping John and Jane. And that's when we get to the why I do this aspect of things. Years ago, they were taken advantage of by, in my opinion, their financial advisor. And when the financial advisor switched companies, they moved all of their mutual funds to new brands of funds, which means they had to pay their load fee over again. And then on top of that, they were also paying, 1% advisor fee. Which ironically they had just negotiated down because I think previously they were paying 2%. So anyway, it just became clear after talking to them that they were frustrated with the situation. And as I mentioned in here, whenever I see things not being done, in an ethical way, it makes me pretty frustrated. And so I like to basically translate that frustration and anger that I experience into a solution. So just like the other articles, nothing different on the background for John and Jane. And the only thing to remember on this article that'll be a little bit different from Jane's is that John actually collects $1,000 a month from his traditional IRA. And John this year is at the age where there is a mandatory it's called a RMD, a required minimum distribution. And that's going to be something that moving forward will depend on the balance in the account. There's an actual equation for it or logic behind it because the goal is that the government wants you to withdraw your money so that you can pay taxes on it. So we know that John needs to be withdrawing funds in order to meet that because there are pretty severe consequences if you don't meet that. But they are very comfortable right now with the 1,700 plus the 1,000, and then also both of them receiving Social Security as well as having some other CDs and things like that outside of what I help them with. So both of the accounts, let me preface this. So with the traditional IRA, the dividend income would have been higher in the month of 2023 for July, but there was a very large special dividend received in 2022 in John's traditional IRA. Give me 1 second. Let me pull up that number because it's a very, very large number. $2,587. And that was, and I'll cover that a little bit later on. But if we subtract that out, we arrive at a small increase in 2023 over 2022. And then in the Roth IRA, we actually saw a pretty substantial increase. And that's going to be because there's been a couple companies that either resumed their dividends after they pulled them in 2020 or just some larger payouts because of the increase in interest rates. So again, I'll go through that as well. But the account balance, we're looking at something about $16,000 less than the traditional IRA year over year. But also remember, we're drawing $1,000 a month out of that account. So honestly, that is about stagnant. It's about as close as it gets year over year when you factor that back in. And then the Roth IRA, which has no withdrawals coming out of it, in the month of July was down by about 4,000. Again, pretty comparable year over year. It looks like I forgot to update this part, and I'm not going to go back and change it at this point. I'll make sure it's done on the next one, that this was copied and pasted over from Jane's. So there's actually 4 companies in John's portfolio that increased their dividends in the month of July. So we already covered Main Street in Jane's article, Realty Income, and WP Carey. We also covered them. So the only one that really is left to talk about is Bank OZK. So they have a very good track record of raising their dividends. In fact, actually, it's kind of impressive for a financial institution. It is very uncommon to be making the kind of raises every quarter that they do, and they've been doing this for the last 15 years. The only time that they slowed down but still kept doing the increases was during COVID, and they changed it from 1 cent per share per quarter of an increase to basically a quarter of a penny per share per quarter. So basically, instead of 4 cents per year per share, the increase was only 1 cent a share per year during that time frame from 2020 to about the end of, I want to say it was 2021, if I remember correctly. There's been a couple of recent downgrades with larger financial institutions, one being Truist Financial, which is actually a holding of John and Jane's, which is one of the largest institutions in the country. As far as Bank OZK goes, we're not seeing the same negative impact on its stock price, which is really interesting given that Bank OZK was no less than probably about 3 years ago was being treated as the next bank to fail. Basically, they had they called it Res G, and it was their real estate development portfolio. Had a couple of loans that went bad, and everyone was thinking that it's their entire portfolio that's that way, and it ended up that it was really just those specific loans that were bad. It wasn't indicative of the whole portfolio. So when we look at the cost basis associated with OZK, ours is extremely low, and that's because we decided to buy in after reading through their financials and saying that I don't see this kind of doomsday scenario for them. So with OZK in John's account, you can see that we're sitting on a pretty decent set of gains here, but the average price is in the mid to upper 20s. And so this is kind of a position that we don't really have any intention of selling. The last time it used to be a little bit larger. I believe it was 225 shares a while ago, and we sold off some shares because they were purchased in the $30 a share range. In fact, actually, it might have even been higher than that. It might have actually been in the low $40 share range. So we had done that in order to get the cost basis where it was lower, but we really probably wouldn't consider selling more shares unless it moved up into probably about the mid $45-ish share range. So for Main Street, again, very comparable to what you see on Jane's article. She has 475 shares compared to John's 425. And on here, there is some cost basis there a little bit higher. We might look at trimming this back, but honestly, with how well the company keeps doing and with the increase in net interest income, it's just there's not really a great reason right now for selling. Again, my strategy, if you've paid attention to it long enough, is to eliminate some of these outliers that are on the high end like this, especially when it's a break even or maybe even a small loss. But like I said, I've got kind of a special affinity for Main Street Capital because management seems to really, back up what they say they're going to do with actions. So Realty Income, this one has swung a lot since we since I published Jane's article, and in John's account, it's currently sitting at a loss in every position that's on there. So that tells us that the stock price right now is definitely trading at its 52-week low, and probably pretty. I don't think it's quite it's like 5-year low, but it's definitely sitting on the lower end of the price. And a lot of this just has to do with rising interest rates, and the increased yield of that stocks need to pay out is a inverse relationship to that. So if you can buy a CD, paying 5.5%, that has no risk associated with it, or at least what we should say is minimal risk associated with it, why would you pay 5.5% for a share of realty income, knowing that there's going to be some level of volatility and risk involved with it? So basically, the way I see it is that realty income stock price has to move lower in order to make sure that it's paying a higher yield to justify to investors why they should engage in the risk. Same thing goes for WP Carey. So their stock price has moved well below its 5-year lows. I think it's touched off at an especially low point because of the recent spin-off that they announced. So as far as I'm concerned, investors are reacting very poorly to this. But as far as I'm concerned, WP Carey is making a good decision. They're spinning off a bunch of office properties and kind of separating the portfolio to put these higher risk assets into a separate company and focusing on the core of what it does really well. So I see it as a buying opportunity, and as you can see from the time that we purchased here, we just did a small number, but that price has since moved even lower. So we're definitely going to continue look at adding WP because I don't see a huge. I see it as an opportunity, buying into the sell-off. I don't see what they announced as a major concern in terms of the viability of the company. In fact, I don't see it as a concern at all, honestly. So as far as the trades go, when it comes to the traditional IRA, you can see that we closed out the position in Canadian utilities. And in this case, it's just about looking at the yield associated with it. I believe it was about 5.5%, maybe 6%. And the logic on this one is just to say, why would we continue, seeing the volatility, especially with utilities? We've been seeing a big price decrease in those. So, why deal with the volatility associated with it if it means that we can just take that same money, put it into a CD or something like that, is going to represent a lot less risk. And if you look at the stock price today for CDUAF, it is down another $4 from where we sold it off at. So I'm not going to say that I'm a genius, and that's why we did it, because you can make the argument on the other end that with Avista that we bought in too early because Avista is also down $4 from where we bought it at. Avista is actually my local utility, and they're I consider them to be higher quality than CDUAF. And where we live at, they have pretty sound operations. But then also with Valero, we sold off here. Unfortunately, we actually sold off a little bit early from where the price has gone to, because now it's over 140 a share. But still, our cost basis is in about the low mid $70 a share range. And so we're just selling it off to put some money away to, again, either reinvest in other areas or to purchase more CDs with. And then in the Roth IRA, everything was a sell on this one. You'll see on the gain-loss table that the Southwest Gas Holdings, this was done to reduce the high-cost portion of the position. Pinnacle West, because of, again, the volatility that we're seeing now in the utility sector, Pinnacle West has dropped by $12 a share. And the reason why the price ran up so quickly was because a while ago, the reason why I got knocked, I should say, is actually that they requested a rate increase and they were denied it. And it looks like moving forward that there's going to be more flexibility with that in order for them to take into account the impact inflation has had on their operations. And then for Iron Mountain, this sell here was, again, Iron Mountain is sitting at its 52-week highs. I think it's a good holding, but at the same time, where we sold off there is just shy of its 52-week high, and actually, when you look at it, it's shy of its all-time high. So basically, we just reduced part of the holdings that were high cost. So the traditional IRA, the realized gain loss, you can see again on here, we took a big gains for Valero, and then we took a small gain for CDUAF. And then on the Roth IRA, when we sold out of SWX, we sold actually at a small loss, and SWX since that time has dropped further. So we sold it at $67 a share, and it's currently trading just over $60 a share. So just like other utilities, we're seeing a price decrease. And again, that's in part because the yield needs to move up, is a big factor in my opinion, outside of other day-to-day operations with the company. I think that the yields are just now finally making the move, because previously people had been relying on stocks like SWX, Pinnacle West, in order to generate income and as a reliable company. But that's when CDs were paying 2%, not 5% or 5.5%. So you can see that year to date, there's been a net gain of 6,600 on the traditional IRA, and then on the Roth IRA, it's been about 3,300. So we've taken some of those gains off the table. You can see the total proceeds and the cost basis with it. And most of the time we really are breaking even. We're typically not selling in order to take big gains off the table. We're looking just to reduce exposure in a position, or to reduce the high cost portion of the position, because it's just good practice. So year over year comparison, HR paid a special dividend from the acquisition of Healthcare Trust of America, and that accounts for the entirety of the income that was received here, because obviously they didn't pay out here. We also doubled the size of the position in Altria, the cigarette maker. So that is a big reason why the income jumped as much as it did, compared to where it was in 2022. And then we've decreased the size of Toronto Dominion. I mentioned in the previous articles, we've been reducing the size of bank exposure, in particular to the Canadian banks. I just have some major concerns about affordability with how high their housing prices are, but also how their mortgages work. So in Canada, there typically is not 30-year mortgages. In fact, actually, I don't even know if I've ever heard of a 30-year mortgage in Canada. Now, you can have a 30-year note, but it's always an ARM. So they typically have, 5/5 arms, or like a 5/1 arm, so where the interest rate is going to adjust after a certain period of time. And so if interest rates are going higher, and if they already have record high housing prices, it's just going to make it that much more difficult for the average person to afford their home. And depending on what part of Canada they're in, is going to, in my opinion, have a really big impact. So and then we mentioned also the WPC, we had actually sold shares previously, which is why the income was down in 2022. And we sold those shares close to about $85 a share. But now we're back into adding, because 85 was kind of the point where it was like, this is absurd. I think it's a good company, but I don't think that it made any sense for it to be trading necessarily that high. So it was a good opportunity for us to get rid of some of the higher cost shares and keep our core position. And then for the Roth IRA, we have Apple Hospitality. Actually, I said Apple Hospitality. I don't think it's called Apple Hospitality. Oh, it is. Apple Hospitality REIT. And so their dividend was decreased significantly down to a penny per quarter in 2020 after the onset of COVID. And it's been slowly increasing since then. They changed it back to monthly, and now it's back to getting, I believe it works out to be about 8 cents a share per month. So it's closing back in on levels pre-2020 in terms of the dividend payout. Similar to the other articles, Eaton Vance's EAFAX has seen a pretty big increase in the amount of dividend income created, and that's just because as interest rates go up, this is going to pay more. We added Essex Property Trust to the portfolio in 2023, similar to what was seen in Jane's article. And then also we added SunTrust Properties. So this is, Sun Communities. And this is a company that focuses on manufactured housing and building what would be considered to be really nice communities where people can buy manufactured homes. They can own the home, but they're on rented land. A lot of retirement communities, but not your traditional thoughts when it comes to like a mobile home park or something like that, where it's maybe not very attractive looking. These are nice communities where people can actually afford a monthly mortgage payment on their house. So we added more of that. I think the price has gone down in part because of the interest rate volatility, but I think that there's a good future for Sun Communities. And then UTF is currently trading at its most attractive price point since 2020, and so we just keep buying. I think that it makes sense. Again, why it's gone down in part is because UTF consists of all utilities. And so as those utility stocks go down, UTF's price is also going to go down with it because it's a closed-end fund. And so the benefit is that we don't have to mess with the individual holdings. It pays monthly, and right now it's currently yielding 9.5%. So there is risk involved, but at the same time, I think that it's got an attractive price point given the underlying assets. So full year comparison, again, we already pointed out that there was a huge special dividend in 2020 that came through, and that the income for 2023 would have been just slightly higher with that backed off. But the Roth IRA saw a huge increase in that income. So because we're reducing the holdings and pushing money towards safer investments, it should be expected that dividend growth is going to moderate, but that there's also a high probability we're going to see income temporarily pull back. So right now, John has quite a bit of money sitting in his account, and I'll show that on another slide. And that money has not yet been invested in CDs or any other instruments that are considered safer, simply because most of these trades have happened within the last week or two. So we typically don't like to move on something until we've had a chance to think about it. Buying and selling too often, being a day trader, for people that do things like that, to me it starts to invoke too much panic in the rationale behind what you're doing. So in this case, the income is likely going to take a short-term temporary hit, but as we put money into CDs, some of these companies that we're selling are yielding less than what a CD is, so it's possible that income in the future might even go up. But moving forward, that income, unless CD rates continue to go higher, that income's going to probably stagnate because it's going to be the same rather than seeing dividend increases from the stocks in the portfolio. So we're seeing a retreat in value. The gain-loss table later on is going to do a better job of showing kind of what's going on here. And then as far as the traditional IRA goes, if you factor back in the $12,000 of cash withdrawals that I mentioned at the beginning of the article, that'd get it close to $361,000, which is how I got about the $5,000 difference in terms of where we are today based on the things that have happened. Of course, the actual balance truly is about 350,000, but I like to look at that and say, okay, does it, again, if that money was withdrawn out, what would the performance have been had it not been drawn out? So the 6-year comparison, it's been 2020 and 2021 were pretty rough. And then we've seen a huge bounce back in 2022. And then we're looking at a potential decline or decrease in 2023. But remember, these yellow ones do not include CD income because it's a little bit too volatile for me to project. Unless I have like a longer term CD. So typically if we're doing short term ones, 1 month, up to 6 months, it's a little bit harder to project something like that. And so as we get those numbers coming in and I update these, it's likely that we're going to see income higher than what's shown here. So this gap for me, in my opinion, is going to continue closing closer on zero. But also remember that it's saying it's 7.8% negative, but that's including the special dividend that was paid last year from Healthcare Realty. And so, really, is it negative? Technically, no, because if we backed that off of it and then looked at the gain that was seen here, this gain would have been significantly less, and so this gain would have actually been positive. And then as far as the Roth IRA goes, saw some really tough years in 2020 and 2021 with dividend cuts, Kite Realty Group, Apple Hospitality, EPR Properties were all companies that we saw cut their dividend in 2020, and they've since resumed paying those dividends, and so that's why we see a good steady growth occurring here. I did like seeing in June the fact that it was the first month ever that the dividend income exceeded $1,000. So we'll see if we can make that happen again here, and moving forward, especially if we're putting money into CDs that pay out on a monthly basis for the interest. So the cash balances in the account, right now you can see them moving up. They're actually quite a bit higher than what you currently see on here, but they also just know that in this section, it does not reflect money that's invested in CDs or money markets. As of current, there is no money in CDs or the money market for either John's traditional or Roth IRA, but he does have about $80,000 in cash sitting on the sidelines, so about $30,000 more than what you currently see right now. And then the unrealized gain loss, it's, the drop in share prices, it makes sense why we've seen it revert from here, and even heading towards the negative, or in this case, steadily staying in the negative in the Roth IRA. But this is also after we saw record levels set in 2022 in terms of the potential gains. And then this table is just to demonstrate that John withdraws $1,000 a month from his traditional IRA. He's happy with that, but he could potentially take $1,350 a month of income. And I should have added another bullet point on here, but another way to think about this is that the reason why I like the dividend income model so much is because it provides the certainty that you need to make sure that you don't have to sell something. So even though we're experiencing all this volatility right now, assuming that the underlying assets are good, that would be, and that of course needs to be the first premise of this assumption, is that John could withdraw the $1,350 a month because that's how much dividend income it generates. And so if, for example, if he did want to do the 1,350 a month, sometimes there's months that are less than that, sometimes there's more than that. But if I was not doing any purchases or any sales, and then no stocks, decreased their dividends significantly, he could, continue drawing out $1,350 a month and never have to sell anything. And that to me is the biggest point, is that you want to have enough cash on hand that you don't have to sell when times are tough. But also, if you can avoid withdrawing funds more than what you need, then you just set yourself up for success and not having to actually sell shares to generate the income that you need. That's when it gets a lot more dicey from an investment and in a retirement standpoint. So these tables that are coming up are my favorite, and they're my favorite because I like showing things when they're good, and I like showing things when they're bad. Now, I don't necessarily like things when they're bad, but I think that there's a huge disconnect between people saying that they lost a bunch of money in the market and them really just seeing that their account balance went down, but they haven't sold anything, so they haven't lost anything. And I was explaining this to a friend of my wife's the other day that was asking me some questions, and the way I always like to phrase it is that you didn't lose anything until you sell. And when you look at what happened after 2008, the people that sold at the bottom, and then when they were at the bottom, they said, no, it's going to keep going lower. And then as it started moving up, they go, no, it's going to correct again. And then next thing you know, they lock in their losses 2 times over, because not only did they sell when the price was low, but then they waited to buy back in until the price went back up, to where it was previously, or at least was higher than where they had sold it at. So that's why, when it comes to the gain loss piece here, accepting volatility is part of the game. And it just needs to be that you're invested in companies that you feel comfortable with, and that you have certainty that they're going to do what they need to do to make sure that they're making good on their dividend commitments. So that's also another reason why we're reducing some of these positions. But for folks who don't want to manage individual companies and pay attention to things like that, that's where we're looking at closed-end funds, ETFs, things like that, is going to be a good option for them. So also, when it comes to the traditional IRA, remember that we could sell every share in here right now and set aside 300 and well, technically it'd be less this 41,000 from the 332,000. So that would be about 290,000. So we could set aside about $290,000, and there'd be no taxable consequence for it if we needed to, because you only pay taxes when the withdrawal comes from the account. So that's where the $1,000 a month that John takes out, that is where it gets taxed. Okay. And then as far as the Roth IRA goes, same thing, where you can sell all these shares, but the difference is that you can make a withdrawal from your Roth IRA, and you could withdraw all the money that's in it in one fell swoop, and there's no taxable consequence that's associated with that. So the tax advantages of the IRAs is part of the reason why we're a little bit more willing to sell, because obviously there's no consequences for John and Jane's taxable income at the end of the year. So this write-up's similar, but I made some changes compared to Jane's article. So just expect to see cash balances continue to increase as we reduce the number of holdings and the size of position. The current gain loss table, the previous 2 slides, is accurate as of September 30th. So when you look at those numbers, just know that all numbers prior to that are representing what happened at the end of July, but those 2 gain loss tables at the end that I say are the most important ones, those ones are accurate as of market close on the 29th. So and remember that with tax deferred accounts, we're going to be seeing more trades happening in there, which is also the reason why if you do have a taxable account, make sure that you understand what your goals with that account are. Because yeah, you could sell and you could take gains, you could sell and you could take losses, but just like our position, for example, in Apple, it's sitting on so much in capital gains right now that if we wanted to sell those shares or if we needed to sell those shares, it's going to create a big taxable event, and it's just in controlling taxes is also just good practice. It's not something that you want to pay an unnecessary amount of tax if you can avoid it. So it's not saying to not invest in that company, it's just to be aware of what your goals are and what your intent with those funds are, since those funds can be liquid at any given time. Okay. I'm not optimistic about the trends in the market. I think that we're seeing some big stress cracks starting to show, and I think that the debt maturities of many of these large companies are going to be coming due in the next couple of, well, even in the next year, going to start seeing some of those where they're going to have to basically re-sign at rates that are considerably higher than what they financed at when rates were basically as low as they could possibly go. So if the Fed continues to raise interest rates, that's going to put more pressure on companies, and when that happens, companies will stop investing in the future. They will stop, or it will dictate what projects they engage in and which ones they don't. So the other aspect is that the biggest bottom line expense for companies is employees. So that kind of signifies why they've been able to hold on to these employees and been able to keep doing these projects, in part because they have such low interest rates that they have more money than they would otherwise have. So when that really low interest rates run out, it's going to be likely that the companies are going to say, okay, we need to cut back. And again, first thing to go is going to be employees, because that's just how it works. And honestly, it looks like that's what the Fed is trying to do. So I'm just finding stocks that that there's limited upside in, or that we can reduce the position of, and have it be at a break even. But if there's a stock that's paying 3%, we had sold some Cummins shares out of the taxable account. But we sold those because we can take that money and put it into a CD at 5.5% and then have no volatility associated with it. So, yeah, if you guys have any questions, leave them in the comments. Thank you everyone who's subscribed so far. And like I said, my goal is to hammer out these articles now that I have a format created, and should be pretty easy moving forward. But thanks for listening to these long videos, and like I said, just let me know if there's anything I can do that'll improve it, or if you have any thoughts about things. I'd love to have more discussion, because that's actually something that I do miss about the Seeking Alpha ones, is that there were oftentimes quite a few comments that were put in those articles, so that it's good, whether it's critical or whether it just gets me to think. I really like getting outside opinions from people, because there's definitely been times where they've helped me think about things that I otherwise wouldn't have thought about. So hope everyone is doing well, and good luck with your investments, and we will be publishing the next video soon. Thanks everyone.